Most people think money is complicated, but it's not. If you understand just a few basic concepts, taxes, banks, inflation, investing, even debt, you'll be way ahead of the average person. In this video, we'll break down the financial basics you actually need to know. Clear, simple, no jargon. By the end, you'll know exactly how money works in your life and how to make it work for you. Let's get started. Taxes are money you pay to the government so public services work. Income tax is what you pay on your earnings. Rates change with income, higher bracket. Key things you must know: taxable income equals to salary minus allowable deductions. Deductions and exemptions reduce the amount the government taxes. Use them. Don't leave money on the table. Withholding means your employer takes tax from each paycheck. If too much is taken, you get a refund. If too little, you owe money. File taxes each year on time. Late filing brings penalties and interest. Why it matters. Wrong tax moves cost you cash and stress. Plan ahead, use basic tax tools, or consult a simple tax app. Banks keep your money safe and move it when you need. They also lend money. Main account types: savings account, for emergency savings, earns interest but usually low. Current checking account, for daily use and payments. Fixed deposits, term deposits, lock money for higher interest. What to watch for: fees, minimum balance rules, ATM charges, and online security. Banks also provide loans, credit cards, and basic investment products. Compare interest rates and read the fine print before you sign. Banks also provide loans, credit cards, and basic investment products. Compare interest rates and read the fine print before you sign. Inflation is when prices rise and each rupee buys less, measured by indices like CPI, a basket of common goods. Causes: too much money chasing too few goods, supply shocks, or rising production costs. Effects you feel: groceries cost more, salary may lag behind prices, savings lose value if returns don't beat inflation. How to protect yourself: aim for investments that outpace inflation, equity, inflation-linked bonds, and avoid keeping large sums as cash for years. Recession equals to economy shrinking for at least 2 quarters. Depression equals to much deeper, longer downturn. Signs to watch: rising unemployment, falling consumer spending, companies cutting costs. What happens to you? Hiring slows, credit tightens, assets can lose value. What you can do: keep emergency savings, 3-6 months expenses. Reduce high-interest debt. Keep skills sharp. Employability matters more in downturns. If you can, invest regularly. Markets often recover over time. Investing is putting money to work so it grows. Major types: stocks, bonds, mutual funds, ETFs, real estate. Core rules: risk versus return. Higher potential returns usually means higher risk. Diversify. Don't put all money in one stock, sector, or asset. Start early. Compounding is powerful. Small amounts grow big over years. Costs matter. Fees, expense ratios, and taxes reduce returns. Choose low-cost funds when possible. Simple strategies: index funds for broad market exposure, SIPs, monthly investing to average out price swings. Keep emotions out of decisions. Currency is the medium of exchange a country uses. Value changes versus other currencies. That's the exchange rate. Why exchange rates move: interest rates, trade balances, political events, investor confidence. Impacts on you: imports get pricier if your currency weakens. Traveling costs change. Remittances vary. If you hold foreign investments or plan to move money across borders, account for currency risk. Consider hedging or local currency options when needed. Debt equals to borrowed money. It's fine when used smartly, dangerous when mismanaged. 2 categories: good debt and bad debt. Good debt: borrowing for education, a home mortgage, or a business with clear returns. Bad debt: high-interest credit card balances, payday loans for day-to-day expenses. Key numbers: interest rate, tenure, and total cost. Always check the effective interest rate and all fees. Strategies to manage debt: avalanche method, pay highest interest debt first, saves the most interest. Snowball method, pay smallest balances first for motivation, avoid minimum payments trap, pay more than the minimum whenever possible. Debt affects credit score. Good repayment history makes future loans cheaper. You don't need to master every term today. Learn one idea, act on it, save a little, avoid costly debt, and make simple investing a habit. So that's the foundation: taxes, banks, inflation, recessions, investing, currency, and debt. You don't need to be an expert. You just need to know how these affect your money every single day. Start small, build a savings buffer, avoid bad debt, and put your money into smart investments. Remember, financial freedom isn't about luck, it's about knowledge and habits. If this helped you, share it with a friend who needs a financial reset, and subscribe.